Good afternoon, everyone. Thank you for joining us today. On behalf of the National Bank of Fujairah, I am pleased to welcome all of you. I am Gavin Kwas, and I'll be hosting today's webinar. And our speaker today is Haitham Abdulla, CFA, Unit Head, Investment Solutions at NBF. I'm sure most of you would agree that investing is a crucial component when it comes to savings and managing finances, but at the same time, it's essential to understand different aspects of investment, like when is the right time to start, when to exit, how do we go about it, and obviously many more questions. Today, we will focus on these important factors and how to simplify your investment plans. We will also see how NBF can help you while you are planning your next investment decision. This webinar is part of the NBF knowledge sharing efforts, where our aim is to increase awareness of common trends, challenges, and opportunities to help individuals and businesses with resources to not only operate, but grow and develop even further in today's transforming environment. NBF's efforts and services are continuously recognized by a number of industry accolades, including the recent titles of the Best SME Bank and Most Innovative Emerging Technology Implementation by MEA Finance Awards. You will also see a poll that is there at the moment. I think there's about 7 minutes for those who haven't actually put in the answers to complete that. So please, if you can do that, that will help with the feedback. Towards the end of the webinar, we will also have a Q&A session. So in case you have any questions that come to mind during the session, please share them through the Q&A tab and we'll address them at the end of the session as much as possible. So I guess investing, it's an interesting topic. And the question that always comes to mind is invest in the right way for you. Everybody is very different. And so how do we go about this? What do we know, or how do we know what is right for you? I think there's a couple of things that we'll cover in this webinar. First one is investments. As we know, they generally appreciate with time, ensuring that you get the most valuable returns when it matters the most. The questions that will come to that is, are you saving for your children's education? So what are you doing it for? Are you saving for the retirement holiday home that you want? Or do you need a source of additional income? Or are you simply trying to grow your savings to hedge against inflation or other factors? While we all have, I guess, priorities in our life, having an investment plan will empower us to fulfill them at peace. So I'd like to introduce Haitham. I think Haitham is going to go through some interesting findings. And I guess the first one there for Haitham is looking at your optimal investment solution. Do you want to explain this further for the listeners?
Thank you, Gavin, for the introduction. Yes, I believe before we start talking about investment solutions, it's very important to understand what are the main factors that make up a good investment solutions. There are several that we put together and that we incorporate in NBF's investment solutions. Number one, first, you want your investment to be aligned to your risk profile and your financial objectives. You want it to be well diversified and well managed, and as professionally managed as possible. You also want it to be able to reinvest and compound your returns over time. And finally, and most importantly, you want it to be liquid and easily accessible for those special times where you need to redeem or exit your investments. So we'll tackle every element one by one. We'll start off with the first one, which is the alignment to your objective. But prior to that, we want to understand what does NBF Investment Solutions does. So in essence, NBF Investment Solutions is basically a portfolio of mutual funds that spreads across between 10 to 15 mutual funds. Now, every fund specializes in an area in the market. Let's take an example. If I invest today $100,000, my $100,000 will be spread across multiple funds that invest across stocks, bonds, and between different regions such as US, Europe, and Asia. Now, there are different portfolios and different solutions, each geared toward a specific objective and a specific risk profile. So as an example, if I were a conservative investor, meaning that I do not like to take much risk, I'm a low risk investor. I'm someone who's simply seeking a return that's better than a fixed deposit, but I'm still comfortable with some price fluctuation. And I would like to invest for a typical amount would be 2 to 3 year period. Then my profile would be conservative and low risk investments would be the place I would place in. However, if I'm more moderate, then I would seek a balance between stocks and bonds. So I want to have some income and some growth in my portfolio, and I would invest in a moderate fashion. Typically, my investment horizon would be somewhere between 3 to 5 years. And finally, if what I'm seeking for is capital growth and appreciation, then definitely I'd be someone who's looking to invest aggressively, and the money I'll be setting aside is money that I perhaps may not need in the short term, and I'm comfortable setting it aside for several years and comfortable having wider fluctuation in the price of my investment. The second point is diversification. We always hear the saying that don't put all your eggs in one basket. And that is very important when it comes to managing investments. The point of diversification, it doesn't eliminate your risk. However, it reduces it significantly, because if I diversify across regions, asset classes, and sectors, it means that my risk is not concentrated into one sector or one region. If something happens to one sector of the economy, the other sectors would basically help and protect my investment. Now, one of the best instruments to achieve diversification is through the use of mutual funds, ETFs, and REITs. And these mutual funds are simply a basket of investments that are managed by a professional fund manager that follows a specific strategy. In NBF Investment Solutions, we try to maximize diversification as much as possible. So we diversify across different asset classes like equities, fixed income, and cash. We diversify across sectors. So for example, some of the typical sectors you'll find in your investment is healthcare, technology, banking, energy, and consumer goods. Another thing that we always do is that we ensure that our investment is globally diversified, meaning we would have investments in the US, investments in Europe, investments in Asia, and obviously that's to protect us from any downside that could come from one of the regions, while the others would help us to basically diversify and reduce the risk across the investment. An important factor of any investment solutions is that we want it to be managed. Now, for those of us who may not have the time nor the experience to manage our own investments on a full-time basis, the use of fund managers and mutual funds helps us a lot. And that's exactly what we do in NBF Investment Solutions. We've selected different fund managers from all around the globe so that they would be dedicated to managing a section or a portion of your portfolio. We put them all together, and that results in a globally diversified, well-managed investment solution.
Interesting. Hopefully for the listeners, that's given them a good, clear idea, particularly around, I think, diversification, which is always a question. People don't quite understand sort of different markets, different industries. So I think that gave a pretty good insight. And obviously the different products that you mentioned there. One of the questions that I'm sure is on everybody's number one question list, I guess you could call it, is risks. What are the risks? How do you associate risks? What type of risk person maybe are you? And that I thought would be certainly something that everybody would like to know. And I'm sure you've got some very good points to discuss on that. Definitely.
Yes. So yes, risk is a very important element when it comes to investing. And we always say the higher the risk, the higher the expected return. So in essence, you cannot invest without taking any kind of risk. Now, what we do is that we try to manage this risk. Now, when we talk about risk, what does it actually mean to the investor? It means that the value of your investment could go up as well as it could go down. Now, depending on how the market moves, and there are several things that can move the market, one of them being the economical cycle, political situation, news that come out, these would affect the value of the investment in the short term, and will cause fluctuations as well as opportunity. However, in the longer run, it is the underlying fundamentals of the investment that drive its long-term return. Now, Can someone eliminate risk from investments completely? No, that's quite not possible. However, there are steps that we take to manage and reduce that risk. So one of the main steps is, as we mentioned, is to diversify and diversify and diversify again. Like we said, we diversify across different asset classes. We diversify across different sectors, and we diversify across different regions. These are put together, give you a very well diversified solution. Next is you should also be comfortable with the level of risk that you're taking. If I'm someone that's investing a small amount of money, that I'm comfortable with having some losses in there, some fluctuations, then I'd be comfortable investing in an aggressive. However, if I'm investing an amount of money that I would not like to risk too much, then perhaps a balanced or a low risk investment would be much more suitable for me. Now, as the market moves and fluctuates with time, this, yes, could cause a discomfort where we can see the value of our investments drop. However, if we build our investment over time, these fluctuations in the market could actually provide us the opportunity to add more to our investment and just focus on the long-term horizon that we set our strategic asset allocation according to. Another very important factor that we consider when building an investment solution is how liquid my investment is. Yes, I should be comfortable taking the risk. However, there are external factors and more of personal factors that someone may come across where you have to exit your investment. It could be at a time where the market is in a drawdown or not. However, what we do in NBF is that we keep our investments liquid, meaning that when you invest, there is no lockup periods. Redemption is available on a weekly basis, meaning that you can exit on a weekly basis. Now, obviously, there's a recommended time horizon for every kind of investment. However, it's a recommendation, not a restriction. You are free to exit your investment at any time if you needed to, and you will exit at the value of the investment at that time. And you can obviously exit partially or in full, depending on what you would require. Now, one thing to note is that the minimum investment amount to invest in NBF investment solutions, we start with a $10,000 if it's a lump sum, one-time investment, or we can do a systematic $1,000. So basically you can contribute $1,000 on a monthly or even a quarterly basis. And you have the full flexibility to start, pause, and stop your SIP contributions at any time with no penalties. Another question that I think a lot of people have in mind is, for these investment solutions, what kind of fees would I have to be paid? We charge a subscription fee that would be aligned with the kind of return you're expecting. Now, obviously, with a conservative approach, you're expecting low returns at a low risk. So we charge a subscription fee of 1%. For a more balanced investment, a moderate investment, that would be at 2%. And for a more aggressive investment, that's basically where you're seeking high returns over a long period of time, we charge a 3% subscription fee. And by subscription fee, we mean an entry charge. This is a one-time fee on entry, not on an annual basis. Let's take an example. If a client invests $100,000 into a conservative plan, his account will be debited for $100,000 that will go to the investment, plus $1,000 that will go to the fees. And obviously, as we mentioned, there are no exit fees. Now let's have a look on how these plans and portfolios have performed over the last several years. We'll start off with the performance of the conventional plans. And here we have a look on how they performed as of end of 2021. Now, the conservative had a bit of a drawdown, but however, it was still in line with what a low-risk investor would expect, at a drop of -1. However, on the other side, the aggressive plan was the highest performer and ended the year at a 9% increase. Now, for a long-term investor, and this is where it matters the most, it's very important to look at the 3- and 5-year return averages for the plans. As we can see on a conservative side, it has averaged close to 4% over the last 5 years. And on the moderate, it was around 5.9, close to 6. And on the aggressive, it was a 9.9, which is almost 10%. and that would basically be the average per annum. Now, obviously, in certain years, it could be higher or could be lower, depending on the performance of the market at that particular time frame. Other than that, we also have available Islamic investments that have performed, as you've seen. They work in a similar fashion to the conventional. However, they're only limited to Islamic investments. Same concept. We have a conservative, balanced growth, and all the way to a pure equity, which is the most aggressive profile of these five. And you can see the performance over the last year, which has been it has outperformed the conventional portfolios in 2021. However, on the 3-year and 5-year basis, they have averaged almost the same. So on the conservative side, they averaged almost a 4%, all the way to the most aggressive, which averaged close to 10% per annum over the last 5 years.
I think there's some pretty good information there. I think obviously it's important for any of the investors to look at this, as you mentioned, on a sort of longer term perspective than looking at over a very short term period. Yes, you might try and get quick wins, but the products grow, as you can see, over a slightly longer period. And it's also important to remember what is your appetite that you're actually looking for. So it's nice to get a balance between the two. I think the things that really stand out for the listeners, I'm pretty sure the fact that there's no exit fees, I think is a very, very big one, and that you can sort of pull out a partial amount of your actual funding on that as opposed to the whole amount. So I think that's a pretty good aspect of the actual product. We're just going to try and see if we can get the poll results before we move to the questions that we have. I think what's quite interesting when we look at some of the poll results on there, we've got sort of a mixture of individuals on the webinar in terms of experience. But you'll actually say that there's probably a few there that are probably more, I would say, inexperienced or new to investing, as opposed to those that are the more experienced. This is quite a good entry for them to understand, particularly around some of the basic terminology as well. And also, I think when we look at some of the risk profiles, it seems that most people probably lend towards that moderate side, as opposed to the aggressive, sort of longer term, I guess, perspective. And that might be because, again, they want to get some good return, but they want to have, funds that they can pull on in a semi-shorter term perspective. If we go to the questions, the Q&A, so I guess there's a couple of things on there, and Haitham, I'll ask you, how do you know the right risk portfolio or profile that is for you, really, if you are not that experienced in investing and you're not too sure?
Yes, that's the role of NBF's investment team, is to basically understand what are your objectives, what are your financial circumstances, conduct a risk profiling to understand what level of risk can you tolerate and you're comfortable with, and then we can basically advise you on what's the appropriate risk profile for yourself and what would be an ideal investment solutions for you that matches your risk profile.
So basically, you would, just for the listeners, you would sort of go through that with them to understand where they're trying to, fit, what are they looking for. So again, you're building sort of knowledge and comfortness with them.
Exactly.
Okay, very good. Okay. We mentioned there beforehand that you can exit at any time, and we also mentioned about no exit fees. You can exit, partially. Do you want to explain a little bit more about that for the listeners in terms of either process or any other aspects that you might think are important?
Sure. So now with every investment strategy or approach, there is a recommended time horizon that's associated with it. However, like we said, this is more of a recommendation, not a restriction, meaning that I can invest, for example, in a moderate investment, which is recommended for 3 to 5 years. However, if I still need to exit, say, for example, after a month or two, I can still exit at the value of my investment at that time. The way it would work in practice is that the investor would basically submit a redemption form to the bank. We process it, and typically within a week, the redemption would be processed, and the investment would be sold, and the sale proceeds would go into your bank account. There are, as we said, no exit fees. However, you exit at the value of the investment at the time of redemption.
I was going to say, and I think that that's an important part for the listeners, is just to understand that while there's no exit fees, it is about what the value of that fund is at, or your amount is at that time. Might be up, it might be down, but that's the important aspect to remember. One of the questions here, if I requested to stop my SIP contribution, is there any penalty?
Now, obviously, the purpose of having a SIP contribution is to help you build your investment over time, set some saving objectives or some certain investment goals, and that would basically help you in the process. There are no penalties if you decide to pause your contribution. So the way a SIP would work is basically, it's like a standing instruction to the bank that on a monthly or a quarterly basis to contribute an amount into your investment profile without you having to ask the bank every month to do that contribution on your behalf. So it's simply a standing instruction. Now,
I was going to say, for the listeners, they might not understand the SIP. So yeah, it's a standing order that gets withdrawn each month.
Exactly. So in the case where you decide to pause your contributions for a certain amount of time, perhaps even stop them or then go back and resume them, you have the full flexibility to do that, and there are no penalties or charges that will be levied on you.
Very good. Okay. How can the investors track their portfolio? Like, how do they get access to see their portfolio, to understand it sort of on a monthly basis?
So what we do is that on a monthly basis, similar to your bank statement, which provides details about your bank account and the transactions within it, we provide a detailed investment statement. Now, that statement would basically tell you how the performance and the value of your investment is, any kind of movement, ups, downs, some positive returns, negative returns, and all of these details will be outlined in your monthly investment statement. In case where you need to know your investment value on a specific day, you can simply call us and we would check it and provide it as well.
Great. And one other question before I move to some of the questions from some of the listeners. Is opening an NBF account, is that a requirement for part of the investment onboarding process?
Yes, basically the investment account is linked to your NBF bank account. The NBF bank account is basically used to fund the investment. Say, for example, I have a SIP contribution, then the monthly contributions will be debited from my NBF bank account. Now, when I sell my investment, the sales proceeds would go back to my NBF bank account. So yes, it is a requirement to have your NBF bank account to have your investment account.
Okay, so we've got some more questions from the listeners here. Is the processing fee, which, if we recall, was 1% for a conservative, 2% for moderate, 3% for aggressive on the conventional, is that same processing fee the same for the Islamic investment product?
Yes, they are aligned with the same profile. So, for example, a conservative Islamic would still have a 1% subscription fee.
Okay, no worries, great. And then somebody else has asked, can I convert an existing fixed term deposit, I think they're saying, at NBF towards their investment or this investment portfolio?
Yes, obviously you can do that. Now, there are two options. You can either wait for the fixed deposit to mature and then deploy it into the investment, or if you're fine with breaking the deposit earlier and investing it, that can also happen.
Okay, great. And then we've got one final question on the returns. One person is asking, 3-year returns were at 9.76, and if I recall, I think that was for the one of the which I'm just trying to work out which one it is now. 9.76 NBF balance portfolio, 3 years. Does it mean that it's 9.76 per year, or 9.76 is the combined return over those 3 years?
Yes, the returns that are shown here are the per annum return. For example, someone who has invested in the NBF balanced portfolio, the Islamic portfolio, 3 years ago, would basically have made around 9.76 on average for the last year. So this is not the combined, no, this is the per annum average return.
So per year.
So basically you multiply this into 3 and you get approximately the total that you've made over 3 years.
Excellent, excellent. I don't think there's any other questions from any of the listeners. I think there's some important takeaways. Do you want to recap on, again, just for some of the listeners, would you like to recap on maybe just some of the main summary points for them so that they can obviously keep those takeaway points and come back with any questions?
I think to summarize basically what NBF investment solutions are these are basically portfolios of multi-asset investments, meaning one portfolio would give you access to bonds, it would give you access to stocks through different fund managers and ETFs. Now, every portfolio would invest in different sectors, in different regions, so you'll have that wide diversification in your portfolio. Now, I think the element of risk is always there with every portfolio, so selecting the right profile that you're comfortable with, and to investing the right amount so that you're comfortable with these fluctuations. Now, obviously, with any investment, and as we go through the economic cycle, there will be some good times and some bad times. Some portfolios could have negative years, some would have good years for an extended period of time. So it's very important to choose the investment profile and invest the right amount that you're comfortable with dealing with these fluctuations. Now, because the investments are well diversified, even during periods of a drop, even during periods of negative returns, what we've seen over the last 5 years is they were able to come back and recover quite well. And that's something that investors should be ready for, is that yes, there will be some periods of volatility and movements. Some investors choose to add more to their investment during such periods. Others might choose to move to a more conservative or a lower risk kind of investment. It all depends on the kind of appetite and the amount of money that I'm investing as a percentage of my total net worth and total cash.
Yeah, I was going to say, I think one of maybe the points of maybe inexperienced investors is to be very nervous about the fluctuations that can happen quite quickly, and that is taking the longer term view, and that longer term view comes down to your portfolio that you choose, but also understanding how it's diversified. We actually have a few questions and we've got a bit of time, so we can cover these off if that's all right with you, Haitham.
Sure.
Having a conventional NBF account and retaining that, can I create an Islamic investment portfolio?
Yes, you can do that. There are no issues with doing so. You can choose, and it can also be vice versa. If you have an Islamic account and choose to have a conventional investment, you can do that as well.
Okay, very good. If I want to redeem the whole amount in my portfolio, is the total amount based on the day the request is sent?
It basically depends on the time that the request is received and the processing. So basically, once the request is received, the team would basically send the request to the fund managers to liquidate the investment and liquidate the funds. To give just a comfort range, it's usually the value for either the day where the prudential request is received by the team or the subsequent business day.
Yeah, so just allowing, I don't know, maybe 24 hours, depending on obviously fluctuations.
Yes, 24 to 48 hours would be a good, comfortable range.
Yeah, okay. Are the returns added annually to the principal for 3 to 5 year plans? Yes,
and I think this is what it goes back to, one of the main elements we mentioned in the past, which is the compounding of return. So to explain this further, let's say I start with $100,000 And then the first year, I made 5%, meaning that my investment is now worth 105. Now that additional 5,000 that I made last year, it stays within my investment account, it stays within the same investment. So in the subsequent year, when I make additional returns, say another, for example, 7%, then the 7% is based on my initial principal amount plus the additional 5,000 that I have made in the past year. And as we progress forward with 100,000 and then additional returns, maybe some negative returns in certain years, it compounds and it builds wealth. In our previous webinar, we've discussed compounding and the effect of compounding in more details, but to summarize it, compounding usually works over a long time horizon because you allow the investment to grow and then you start making returns on your principal plus your previous return, and it starts to accumulate and build up over time.
Very good. Yeah, I think the compounding understanding, again, is something that just takes a little bit of time, but I think that explanation makes it quite clear and quite useful for the listeners. A couple more questions. Do the investors get to see the underlying funds in the portfolio?
Yes, that's part of their detailed monthly statement. They would see all the funds. They would see how many units they have in each fund. They would see the value of the funds and any movements or fluctuations in every single fund.
Great. Another question, which I think is an interesting one, and I think you know your answer, but somebody's asking, when is the right time to top up? I'm not sure if you have a crystal ball. Maybe you might be able to let the listener know, but what would you sort of give as feedback on that?
It's highly dependent on what's your objective. Now, some people might say that you can top up your investment when the market is down. Now, take, for example, situation now. There's a situation in certain countries, political issues that caused the investment values to go down. Now, someone who wants to build their investment and add more to the investment will see this as a great opportunity to basically, like we say, buy at a low price. So this could be a good opportunity for someone who is more of an aggressive kind of investor. However, for someone who wants to be just basically principled and steady and consistent, if you have a monthly plan, then you would basically add to your investment and top up to your investment on a periodic basis, on a fixed date. So meaning that you do not look if the market is up or down, you just keep topping up on a consistent basis. Now, this approach, from what we've seen and from our experience, has been more of the safer approach because you're basically building your investment over time, regardless of how the market moves. However, certain people that are more keen to take risks would usually, whenever there's a drop in the market, they would add more to their investment and top up their investment. So different approaches, but the idea is to focus more on the long-term horizon and not to be scared or persuaded by short-term movements.
And I think that's one of the one of the benefits of having maybe a product like this, where you're not seeing it on a day-to-day basis, or you're trying to manage it yourself, because those sort of those sort of changes that you see quite rapidly can be quite scary, and people can get quite very jittery quite quickly. Somebody's asking, what if they start at a conservative level and then they would like to shift, let's say, to an aggressive profile? How does the processing fee on that sort of get calculated?
Now, to start off, usually it's always recommended that you start with the right profile for you. We also have available that you can have multiple investments. Let's take an example. If I want to set some amount of money in the moderate plan and some amount of money in the aggressive, I can freely do so. We allow you having multiple investment plans at the same time. In the case where you started with one plan and want to shift to another, specifically on the processing fee, we only charge the difference in subscription charges between the two plans, if there are. If there are no differences, then there is nothing charged.
Just to go back on one of the questions that you mentioned, so you explained about if you put say 100,000 in and you got 5% return, one of the listeners is just reconfirming that therefore in the second year, the investment will be 105,000 as opposed to 100,000. So just to clarify that point, and then the percentage will be on that 105,000 as a compounded growth.
Exactly. That's exactly how it works. That's the value you would see at the end of the, let's say, for example, the end of the year.
Okay. Somebody is saying, is there a subscription cost in switching between the portfolios? So from aggressive to conservative or vice versa?
If it's, like we said, if there is a difference between the two, for example, if you're going from a lower risk, that's a 1% to a higher risk, which is a 3%, then you'd basically be paying the difference, which is a 2%. However, if you're doing it the other way around, meaning that you're going from aggressive to conservative, then obviously you do not pay any additional charges since you already paid the 3% at the start.
Somebody's asking, how can they get more details about the plans and how can they potentially subscribe in it?
Obviously, you can reach us through multiple channels. You can reach us through social media. You can reach us through the website. You can even call the call center. What I would suggest is that going through the website, NBF's website, there's a tab dedicated to investment where you can have more details, and then you can send us your contact details and we will speak to you and contact you and perhaps even have a meeting or a call together to walk you through the investments, share additional details and answer any of your questions, and then help you with basically subscribing into any of the selected investments.
Great. Last couple of questions. Do you only use funds, or are you able to allocate structured products, be it in equity, fixed income, or in other asset classes?
Now, structured product is a different type of investments than the investments that we've shared. Yes, structured product is also part of the product suite. However, typically structured products are designed and are limited to professional qualified investor because of their complexity. Now, if someone is interested in specific structured products, they can always reach out to us and we can assist them with that as well.
Okay, great. Next question. Can the customer view the portfolio on the NBF mobile app?
At the moment, that option is not available. As we mentioned, we provide the monthly statement that you receive on your email, or if you need to get the value of your portfolio on a specific day during the month, you can always contact us and we will provide it.
And just to recall, I'm pretty sure the answer is $1,000, but what's the minimum amount to start a SIP?
To start the SIP, the minimum contribution is $1,000. However, you can choose to do it on a monthly basis, or you can even do it on a quarterly basis, meaning that every 3 months I would contribute $1,000.
Correct. Okay, and then finally, somebody said, I'm an NBF customer. Can I contact my relationship manager to get an investment subscription? Yes, you can. You can do it that way. Or as Haitham mentioned, there's multiple other channels that you'd be able to contact us on. You can also connect with both of us, both myself and Haitham on LinkedIn, or feel free to contact us through one of the other channel methods. Anything to add on that, Haitham?
Yes, typically the recommended channel for people that want an online channel is the website. One is that you will get more details about the investment there. And two is that you will share your contact details that will come directly to the investment team, and the investment team would contact you as soon as possible to share all the details and discuss with you your investment objectives, and then go through obviously the process of risk profiling and then placing in the ideal or optimal profile and investment solution.
Haitham, so thank you very much for that useful insight. I hope the listeners all enjoyed that. I think it was very useful, gave a good insight in relation to our overall NBF investment product, but also how you can start with investing from a small amount to also increasing it depending on your appetite. There's a couple of key points there, as Haitham mentioned, on understanding your risk, but feel free to reach us and we'd be happy to talk to any of you if you are interested. From NBF, thank you very much. Please do keep an eye on our upcoming webinars. You'll find them on all of our social channels. But thank you very much for joining us today. Haitham, thank you very much. And to our listeners, thank you very much.